80 to 90% of retirement plans now allow for a Roth deferral, yet only 1 in 4 participants are taking advantage of it. Here are the top excuses you are using to not contribute to the Roth and why you're wrong. Number one, I make too much money. False. These are lies. There is no income limitation on a Roth 401k. There is on a Roth IRA, but I can assure you, you do not make too much money to contribute to your Roth 401k. Number two, my projected income in retirement will be lower. Therefore, I'm expecting a lower tax rate in the future. Fine. I will totally ignore our ballooning US debt and I will grant you that assumption. Here's why I really don't care that much. This is the formula. Accountants, pay attention. I kind of blame you. Taxes owed is a function of two variables, not just one. Yes, tax rates matter, current and future. But the other thing that matters is the taxable base. And here is where the Roth shines. Because if you follow the distribution rules, all of the growth in the Roth can be tax-free. All of it. That's not the case for the traditional. You can get your tax deduction in the traditional today. Let's say you save $10,000 and let's say in 10 years it doubles to $20,000. You're going to owe taxes on your original contribution and all of the growth. But in the Roth, if you save the $10,000 today, you're not going to get the deduction. But if it doubles and it becomes $20,000 in 10 years and you followed all of the rules, then you basically get that $10,000 of growth tax-free. Yes, tax rates matter. But we have been blind as an industry to the taxable base and the benefit of the growth in the Roth. Third excuse. But if I invest the tax savings that I get from the traditional, then the math lines up. I'm not going to argue with that math because it sort of does. What I will argue, though, is behavioral finance. First and foremost, most people don't take the extra step to actually get the tax savings and reinvest it, okay? Another step. If you are looking to max out your retirement contribution, whether it be in a 401k or an IRA, you truly cannot max out a retirement plan contribution in a pre-tax fashion. A portion of that contribution will always be earmarked for the government. The only way you can truly max out is to use after-tax dollars, which again, by default is more retirement dollars saved for you. Now let's take it to the 401k industry because here's how Michael Kitces explains it. He says, if you are using outside dollars to pay the tax liability, then the Roth will always be more favorable. And this is exactly how the 401k industry is structured by default when we look at deferrals through our paychecks. When you elect a percentage to save in your retirement plan, it comes off of your gross paycheck. So 6% is 6%. Let's say on a $1,000 paycheck, it's $60. Whether you choose traditional or Roth, $60 is going into your retirement account. You don't pay the piper. You don't pay the taxes until later on in your paycheck when your withholdings are adjusted, which means someone saving $60 in the Roth is actually saving more in their retirement than somebody saving $60 in the traditional because it's all after-tax money. It would take some major behavioral mental hoops for participants to go in and adjust their percentage deferral to accommodate the tax deduction, and it just doesn't happen. Now, final excuse. What if the government changes the rules? Touche. I will actually grant that one because I do believe in 20 to 25 years, our government's going to see all of these really fat 401ks that are Roth and that have Roth in them and see it as a potential source of revenue. But if you look at the way that the government has implemented tax law changes in the past, they have set a standard for grandfathering accounts. So I'm banking on them grandfathering Roth accounts prior to any tax changes. Or at the worst, I don't see them taxing our contributions because that would be double taxation. I do see them potentially taxing the growth, which just turns it into a traditional at that point. So, same thing, right? Here's what we have to combat as an industry, and it's not necessarily an excuse, it's by design. Auto-enroll. Most of the plans that have auto-enroll are auto-enrolling into the traditional deferral rate. So we have to over communicate and educate, because now we're asking you, the investor, and plan participants to actually go in and make a change, which we all know we're too lazy to do. So what we need to do is have consistent and thorough education on the matter. I'm not saying the Roth is best for absolutely everybody, but I do believe with minor changes today that most participants won't even notice on their paycheck could lead to major benefits 30, 40 years from now. That's it for this week. This is Jeannie Fisher, the 401k lady.